How will rising mortgage interest rates impact the Seattle housing market? Last month, we saw prices in Seattle, Bellevue, and King and Snohomish counties reach their highest point ever for residential sales. And interest rates also reached their highest point since 2019 this last week. And people are asking me, what is going to happen in the Seattle housing market and overall as we head into the traditionally really hot spring market? Zach McDonald, your real estate agent here, and I want to talk about these questions, and I think some of them are fears and concerns as well for people who maybe are thinking about selling a house this spring. And for buyers, is this a bad time to buy? Is this a good time to buy? What's going to happen in the market? If you follow my monthly market updates, you will know that there are two key factors that are really driving this market right now. Number one is the supply, the amount of homes for sale. There's just not enough houses available for all the buyers. Number two, you'll know that mortgage interest rates have been at record lows over the past few years. And right now, I'm telling you that we're seeing those increase. So there's starting to be these questions. Well, we've been talking about low interest rates and supply being an issue and obviously driving factor. What's changing now that interest rates have been going up? Or better question, what will change as mortgage rates go up? I want to talk a little bit about supply first and just kind of dive into this a little bit. Last month, Seattle, Bellevue, King County, Snohomish County all had 0.3 months of supply. And what that means is we have about 1 week of houses available for all the buyers. And if we're looking at a more traditional market, 2 to 4 months is a little bit more of a balanced market. More than 4 months is getting closer to a buyer's market. And in this case, being below the 2-month mark, we're in what's called a seller's market. And right now we're in a super hyper seller's market, which means buyers are competing like crazy to get houses. They're paying more than asking price and also removing contingencies in the contract and trying to write contracts that are as favorable to the sellers as possible when it comes to the terms. And what we're seeing is that we're in this kind of record low supply, and we're also not seeing enough new listings coming on to keep up. Now, I want to put one myth to rest, and that myth is that nobody's wanting to sell their houses right now. And that's just not true. If we look back at historical data over the last, even if we just look at the last 10 years, we're actually seeing more houses coming on the market. I'm recording this at the end of March 2022, and we're still looking back at last month's data. The new data will come out. So again, check out the next market update when it comes out. But what we're seeing is the same amount of listings, or even more than we normally would at this time of the year. We just have a lot more demand. So unless we can somehow get a whole bunch more listings on the market or demand severely drops off, we're still going to continue to maintain or continue to move forward or grow on the price front. Now, I think it's important to share a little bit of context behind why we are seeing record low supply numbers, because I think sometimes we forget the why behind the what. The what is that we have low supply. And the why is, I think, a few things. Number one, builders are super far behind. And this is just nationally. Builders haven't been able to keep up with demand for the last, 7, 8 years. But we're super far behind. And there have been lots of reasons for that the last few years. And at the same time, we have the millennial generation. Okay, that's my generation that is now buying houses. And the younger millennials are also buying houses. And the millennials are now the largest generation. They've overtaken the baby boomers. That's a few years ago. But you have the largest generation of people buying houses. You don't have enough houses being built. And there's still a whole bunch of people that own houses and don't want to move. So you've got more people buying houses. And I think a lot of it's now you've got the younger millennials that are starting to jump into the market a little bit later than previous generations buying a house. But unless for some reason people aren't buying houses, and we'll talk about what could be affecting that, we're not going to see a big shift. That's my thoughts. So mortgage rates, historically low, but still on the rise. What's going on? Back in 2021, beginning of January, if we look at Freddie Mac's primary mortgage market survey, so every week they're surveying rates across the country, 2.65% for a 30-year fixed rate. Crazy. If you look at January 2022, that's the beginning of this year, 3.22%. So we're up quite a bit from last January, but still really low, 3.22. I have a 3.25% rate on my house. I did not refinance a second time as they kept going down. I kept my rate. And now we're seeing, as of last week, 4.42%. That was their average weekly rate, which is up 1.25% year over year. Okay, so we're seeing rates climbing up. If we look at Bankrate, another survey that they do on a weekly basis, at the end of last week, 4.53% was their survey number for the whole week. As of today, March 29th, they're quoting an average of 4.86%, which is up 33 basis points from a week ago. Okay, so we're seeing rates continuing to go up. This is an active thing. So what's going to happen? I think that's the concern. What is going to happen? Number one, with demand. Hey, what's going to happen there? I think, number one, housing affordability is becoming more and more difficult. Prices are already really high, which is impacting affordability, right? It affects the affordability. But you also now have rates going up, which makes it even harder to afford that price because it's a lot more expensive on a monthly basis. And lenders are looking at what's called your debt to income ratio as they're qualifying you for a purchase. So they are looking at income, right? That's the debt to income. They're looking at your assets, how much you have, and your credit. But if you don't have a large enough income to support the payment on the debt to income scale, you're not going to qualify. So it does cross some people off the list of even being able to purchase a house altogether. Most likely, what it affects is that luxury purchase. So those higher price points in the market are going to feel it first, and do feel it first, because people maybe can't afford to buy the nicest house and they have to compromise a little bit more to make a purchase. That also will make those more median level houses, median price points, more competitive. So it doesn't really make it easier to buy, it just makes some of those people that were going to be out of that price bracket into a different house, and making that middle bracket a little bit more competitive. It also will then impact the people that maybe would have sold and bought something else. Maybe they can't buy the house they wanted to buy because the rates have gone up, so they're going to stay put, right? So some people will just not buy. They'll stay put in the house that they have, which will also decrease demand. Some buyers will be spooked. They'll be like, oh my gosh, highest rates ever. And they are going up, but they're still historically low. And if you're able to buy a house, the rates aren't that bad, but they have been better. So some will be spooked. And then what's going to happen to supply, right? So we've got demand being impacted by affordability, some people maybe being afraid, and also some people just choosing not to sell and buy because of the rates being up. And they want to keep those low rates that they already have. Well, when we get into the spring, typically we're seeing more listings coming on the market. So we're still going to see more listings coming on the market, is my prediction. I think we're also going to see, as I mentioned, some people staying put, which will reduce the amount of listings. It's not going to increase the amount of listings, but at the same time, we'll see people thinking, I want to capitalize on this hot market and take advantage of it. So you've got both sides of that same coin. People that want to stay in the area maybe aren't going to buy something different. They'll stay put. But if somebody's thinking about moving away or downsizing in the near future, they might sell to capitalize on the record high prices, and assumption, or at least with maybe the fear that things could change soon, and they want to make sure that they don't miss the boat. So the overall consensus here, as we boil all this information down, okay, I think that we are not going to see a massive drop in prices or a drop in prices as we head through the spring. Every year we see the values lag a little bit on the median sales price come the fall and winter. I think a lot of that's just mainly that the more expensive houses sold at different times of the year, and those percentages are and those numbers are off a little bit. But that's just my thought there. I think as we're looking at the spring market though, we're still going to see people selling their houses. We're still going to see people want to purchase houses, even with rates going up. There may be fewer people looking to purchase, and there may be fewer people even looking to sell. What I think is we'll see less competition in the market. So we'll see less of the above asking price crazy 20, 30% like we're seeing. Maybe we're going to see a little bit over asking price still. Again, I don't think we're going to see home prices plummet, but if demand decreases and supply increases a little bit, right, is going to make it so that people don't have to compete as much for the same houses. With that being said, even with inventory picking up, there's going to need to be a lot of new houses coming on the market and a lot less people interested in buying in order for the Seattle market specifically to see any kind of drastic shift. So as we're heading into the spring, as we're heading into the summer, I don't want to sound the alarm and have people terrified. I really do think we're still going to see a really strong spring market here and a strong summer market. And in the long run here, over this next 6 to 12 months, I don't see prices dropping off or having there be a bunch of deals and discounts. But I will say back in 2018 to 2019, we did see mortgage rates jump up to the high 4s, low 5s, and it did start to affect prices a little bit. And we did see a little bit of a lag in the median sales price for 8 months in a row. So if we put all that together, there may be a slight decline in prices as things kind of level out a little bit. And that's the idea of raising interest rates, is to slow things down a little bit. But I wouldn't be terrified or run for the hills if I'm a buyer. And I also wouldn't necessarily sell if I was a seller just because I was afraid that my house was going to decline in value severely. So I hope this video was helpful for you. It's a lot of information. We talked a lot about supply and demand and how that all is impacted. We talked about the two main drivers here being supply and also interest rates. If you want to continue to follow along and hear my thoughts on a regular basis about the Seattle real estate market and the surrounding areas, please subscribe to my channel. And if you know somebody who could benefit from seeing this video or others, please share it with them.